I know for me, there are so many people asking me always about extra little things and tips that they can do with paying less tax. I know I'm always looking at paying less tax, but I thought it would be great to talk today about some extra things you can do when you own an investment property on how you can save more tax. And Juanita, you guys were both in the office. Brennan, you were telling me about this as well, about prepaying your interest. Now, I knew about it, but I kind of forgot. So I thought it would be great. Can you explain what is prepaying your interest and how can that work for you?
It's a really popular strategy actually that we use for a lot of self-employed people, and it really does have to be part of a plan. We do this day in, well, not every day, but we do this a lot.
Every year.
Every year. Every year. Applications have to be in by March. Is that right, Brendan?
Yeah, look, there are other options I can talk about thereafter, but
yeah.
March is ideal.
So prepaying interest. So what happens with that is we basically look at prepaying the next 12 months of interest now. So in advance, yeah. So you'd pay it now. You'd pay it this financial year. So you pay it before June, and then you get to claim it in that year's as a tax deduction for this year's income. And it works as a really good strategy when you're dealing with self-employed people. If we can increase their income a little bit this year and then drop it down next year, it works in, especially when we're transitioning to retirement, like a 5-year plan for that.
Yeah.
When we might want to sell properties down with capital gains tax. And so if we've got the ability to play around with incomes, which we do for self-employed people, prepaying interest is an excellent strategy that we can use to get your tax deduction for this year while we've got your income higher. The trouble with it is, though, a lot of clients know about it, and we've done it for them before. They usually don't contact us until May. And by then it can be about a 3-month process at the moment. Is that right, Brendan?
Yeah,
generally speaking?
It depends on the lender they use, but really, March is the time to be looking at that, especially if you're doing a traditional approach where you're fixing it in from July 1st to June 30, which is how a lot of accountants, a lot of our clients like to approach that.
But you don't have to, actually.
That's right.
Yes.
There are some lenders who, because effectively what you're doing with interest in advance is...
Just as long as financial year.
You're taking a 1-year fixed loan.
Yeah.
So you often get a discounted rate as a result of it being interest in advance. So you get a discount off the 1-year fixed rate. You're paying that in advance. So there are some lenders, and a lot don't advertise that they do it. So again, that's where you come speak with us, because we know which lenders will offer it as an exception based on your circumstances. But it's essentially, once you have locked that rate in, the date that you pay it is the financial year, of course, where you get to claim the tax deduction.
So if you're paying, say, $50,000 worth of interest for that loan, that would be an expensive – it would be. And I don't know many people that have got $50,000 sitting around. All right, let's go $25,000. And if you're in the highest marginal tax bracket, you effectively get $12,500 of that back 1 month later. You know, so you pay that in June. In July, you get $12,500 back. Ideally, you'd invest that into something else and so on. But it's used more for income, like for us to play with incomes than anything. And just the fact that you pay that and you get it straight back. And I know you get it back anyway, but this is a way where we can sort of manipulate it a little bit better.
Well, you're reducing the loan amounts in effective, or paying the interest
well, just
off.
You know what you're doing for the next exactly. And you've got...
So what you were saying before, it's like if people are looking at selling portfolio properties, like properties and assets, if they actually have a meeting initially, and this is what I say, plan what you're doing.
It's really important.
What you just made me think about a few clients I know that are in retirement, selling assets, and one of the biggest things is I don't want to get off topic, but the capital gains tax.
100%.
What you just said now, by prepaying the tax, knowing that you're having the plan to sell a property in that financial year could help, as well as my other clients that are on high incomes. They could also be PAYG, high income earners, looking at how can I reduce my tax.
That's right. It's an excellent strategy for that. The transition to retirement's an interesting one, because you really have to start a good 5 years out selling properties so that you're not paying, especially if you've made a lot of gains. You don't want to sell them all in 1 year. And the other thing with the transition to retirement is that you're only allowed, and this is very general, you're only allowed to put so much money into super every year.
Yes,
and
without being taxed again.
And you really want to maximise that amount. So if you give yourself 5 years, because the more you can get into that super environment, it's tax-free pension. you know, when it's in that super environment. So when you do transition to pension phase, the more you have in that super environment, the better. So you really do want to start your planning, you know, 5 or 6 years out.
And again, I think that's where we work so well together as a team, because those
100%.
clients who are working on going with a financial advisor will have that in plan that many years out. But I think the conversations I'll have with, you know, yourself at Grow Property, myself with Hudson, you know, in the finance team, will be the extra line of defence to identify those opportunities. So look, if you're looking to sell that next year, you may be attracting a capital gains liability. There are other options we can look at. You need to speak with your advisor, because if we're going to be doing a fixed interest and advance loan, we need to get that in place by this date.
Yeah.
And you can help with the sale as well. So we look after each other. We can sort of, you know, work with you over the next few years when we're putting a plan together.
Yeah. Timing of the sale, everything.
Yeah.
We can save thousands and thousands and thousands of dollars with using the super environment and capital gains tax. So it does all come down to planning. A lot of it is planning.
So what about negative gearing?
Oh, contentious issue, isn't it?
Well, obviously negative gearing has the tax benefits, and that's something we obviously talk a lot about with property, because one of the biggest advantages of buying in Australia is the negative gearing tax offsets. So Brendan, do you want to maybe...
Yeah, look, I'll start with the lending perspective, because it's interesting with lenders in Australia, only some, so it's not all, and it's, you know, potentially slightly over half will actually factor negative gearing or the proposed negative gearing benefit back into the serviceability calculator. And of course, serviceability calculator is what determines your borrowing capacity. So how much your income can actually service on the loan.
It's only half.
So it's potentially a little more over half, but there are a lot who don't as well. So there's a real change in there, but there are options. The important thing is, if that's an important part of your borrowing capacity, then again, it's knowing which lender to use, which actually factors that into the calculation, because it'll generally say on $1 million loan make the difference of an extra, you know, 150, even up to 200,000.
It's a lot.
You know,
in borrowing
capacity, yeah, and certainly, you know, at least, you know, an extra 75 to 100,000. That's very circumstance specific. Depends on how much the loan is investment, how much is owner occupied. But again, that's where you analyse that situation first and understand that. So from a lending point of view, it's even contentious in that only some banks do offer it.
Yeah,
I think from my point of view with lending, Brendan, you and the planners need to work together, because structure is really important when it comes to negative gearing. So obviously if there's a high income earner, and it depends on who's buying the property, but if you've got 2 income earners and one's on, you obviously want to be in the highest tax bracket to make negative gearing absolutely work. It's hardest for you.
Yeah.
So, and then of course, the more properties you have, the lower your tax rate drops. So it's very much working structure. So if you've already got 3 properties in the highest income earner's name, it could actually be that the partner or the joint party, if there is 2 parties, who hasn't earned as much might actually be earning more now, because the negative gearing will have dropped. So it really, when it comes to negative gearing or investing, I cannot stress the importance of a plan more, and working in, not just having a planner who works in with a finance expert like Brendan, because structure is really important. And even coming down to things like trust, we have a lot of clients who are buying in trusts. There's a lot of talk lately about trusts and trying to find like-minded individuals to buy properties in trust, because property prices are so expensive. So all of that needs to be done really carefully, and with the integrated or the collaboration of the finance department and the advisors, because they really work hand in hand.
So for negative gearing, for anyone that doesn't know what it is, it's basically when the difference between the rental income and the outgoings of a property, there's a negative component. And if after all costs and income there's a negative, that amount that you're negative can be claimed back. So all the expenses associated with an investment property is 100% tax deductible against your taxable income. And when you're younger, when we talk about that life cycle, and this is what I say to a lot of clients, I'm like, when you're starting your journey of work and you're young and you're in that income phase of starting to really grow and continue earning more and more, that's the time you should be negative gearing. As you get older and you're going down to that 5 year, that's when those properties, that's when you want that to be more positive.
Neutral, or at least neutral.
Or neutral. Yeah. But at the end of the day, right now, there's all these Instagram and there's all these people pushing things online around positive cash flow property. But
it increases your tax.
You're increasing your tax. So again,
at the very best, you'd want it neutral.
100%.
The thing I just want to mention about the tax benefits, stamp duty is actually it's a cost basis. So when you pay stamp duty, it's actually not, a lot of clients think that's tax deductible.
Yeah.
It's actually not, it adds on to the cost basis when you go to sell.
But
interestingly, a lot of clients don't think mortgage insurance is tax deductible.
It is.
Yes. And
all
so
the loan costs are tax deductible over 5 years.
And so, exactly. And so when we have these conversations with clients and they're like, we don't want to pay LMI. And we're not able to sort of talk them. We need to educate them as to why they don't want to pay LMI. What is and LMI is lender's mortgage insurance. Actually, Brendan, I should let you probably talk about that. But generally speaking, if you're young,
how are you going to get into the market?
With a 20,
how long will it take you to save that deposit?
I'm trying.
It can be an opportunity cost. That's right.
Yes, and it's tax deductible.
Opportunity cost. When you look at the percentage of it over the size of the loan or the property being purchased, it can absolutely be worthwhile. And look, on that, most lenders do charge LMI, so the lender's mortgage insurance, if the loan to value ratio is over 80%. Yeah. But even with that, there's at least one, and there's been a few who have dabbled in the space, at least one lender who, for a owner-occupied purchaser, will go to 85% with no lender's mortgage insurance. And then there are variances within that. There's obviously government schemes if you're a first home buyer. But outside of that, for investors, it's something we see regularly. Investors choosing to pay the LMI, they factor in as opportunity cost. And you mentioned before all the expenses being, tax deductible against the income against the property. And of course, that's all the interest expense as well. So as much as, looking at it from the angle of first home buyers, understand that only the interest, not the principal part of your payment, is deductible. We have a lot of investors who have 2, 3, 5, 10 investment properties and there's new extra rules come in once you've paid off your owner-occupied home, who will move those to interest-only lending so that the entire payment they're making each month is tax deductible, move it to more of a neutrally geared property,
and I think also,
and free up that cash flow for other investments.
I was just going to say that. Yeah. I think from an investment point of view, the more leverage that you can generate from the bank, the more you've got in the market, and of course, the more you leverage you've got, the more you can lose, but also the more you can gain. Yeah. So it comes back a little bit to your risk profile or your risk tolerance. But if the banks would give me $1 million right now, I'd go and buy property. Yeah. And that's.
Well, I've got a good broker for you.
That's
exactly right. And look, once you're into that, once you do have those extra assets at your disposal, so there's other things come into play as well. There are products in the retail space and certainly in the private banking space, both of whom we work very closely with. So it's not just private banker or broker. We're working closely with the private banking teams, where you can have even as long as a 40-year interest-only loan, which services on the actual interest-only repayment, not on the ability to repay that. But that's around certain caveats like having an unencumbered owner-occupied. So there's so many nuances and
there's a lot of education that's needed around that, though, because a lot of clients still think that they should be paying P&I on a loan.
And I think that's all individualized, right? Absolutely. And that's the biggest thing is like there is not a one size fits all that we're talking about. No. Everything we're providing is just like, hey, these are some things to think about, but you need to do a meeting. You need to sit down with someone and look at your individual situation. Yeah. And like on that negative gearing, like so many people like are uneducated around the fact that they are paying that much tax. Like I think people just look at their gross earnings and they think, oh, I'm on 120,000. I'm on, well, no, really. This is how much you get to take home. Why don't you look at ways you get to take more of that? Because at the moment, someone else is receiving that money you could be putting that $200 a week towards an asset that grows. So negative gearing, there's a place for it. I think it's a really good place to grow a portfolio if you're earning taxable income in Australia. Yes. That's the key. But I'm not against P&I. I'm not against interest only. I think it comes down to affordability and your individual circumstances. We touched on structuring your loan a little bit and looking at that. But what about, what's the benefit of new versus old? And you kind of said that a little bit around depreciation.
So with new buildings, you get to claim depreciation. With old buildings, you can, but you have to get a depreciation schedule done up. And a lot of clients will regularly get depreciation schedules. It's actually quite interesting. A lot of clients don't continue to do it though over the years, and it's a constant reminder to them to get a new depreciation schedule done up so they can maximise their tax return. You just said earlier something that we talk about all the time, and that is the only way to increase your cash flow each month is to minimize your tax or increase your income somehow, take another job, get a promotion, study, better yourself. And a lot of people just look at that, like you said, that dollar that they're making, and they think they get paid, $5,000, but they're really getting paid $9,000.
Yeah.
But 4,000 of it's moving off. So if you can bring that back, even a portion of it back, it increases that cash flow that you've got to spend on making your money work harder.
That's right.
So depreciation is a big area, and some clients get very hung up on that though. They want the brand new property because they want the depreciation.
So depreciation on a brand new property, you can claim for 40 years.
40 years for the building.
The first 5 years of owning an asset is the highest amount that you depreciate it because that's the biggest time frame that things that you can, according to the quantity surveyors, can depreciate.
That's right.
So that's why more people go for new on high taxable income and they get to depreciate it. But you can claim depreciation. You should do a new quantity surveyor's report if you've done any renovations on the property. So you could, if you've upgraded anything that's a fixture, like flooring, any aircon, things like that, you can depreciate that from the time you buy it for 40 more years in terms of depreciation. So like a car is depreciating in age and you get to claim that. The difference is a property's appreciating over time, but you get to claim that. Now that can be anywhere on our scenarios. It could be anywhere from $6,000 to $15,000 a year that you don't physically pay anyone, but you get to claim against the taxable income.
The only thing on that is that sometimes clients get caught at the other end because that does come off their cost base. So when they go to sell, they forget that they've claimed depreciation. So they go to sell the asset and the asset's actually worth less than what they bought it for a capital gains perspective because the depreciation comes off that cost basis.
So again, it's something you want to really talk with your planner about and weigh up
when you're doing your plans, depreciation's excellent and it does give you that instant tax advantage, but you'll pay for it slowly at the other end. And we can do scenarios there to show you based on, a 6% return per annum or whatever sort of figures we want to put in. And that's the thing with planning. You're doing a lot of assumptions all the time. So you're assuming you're going to hold it for 10 more years and that you're going to claim this much in depreciation so that in 10 years when you go to sell it, your capital gains tax will be X amount extra based on claiming that depreciation. It generally always comes off that you're better off to claim the depreciation, at the beginning.
So if someone what you're saying is if you had a short-term strategy, like someone was
trying to flip,
told you I'm only going to keep this for 5 years or something like that, you would recommend not depreciating?
I would want to run a scenario for them because we'd have, and again, we're guessing what sort of capital growth they're going to make.
Yeah.
So it's a hard one. And so I would always say take it because it's a guaranteed cash in your pocket that you can, at today's money, invest into something else and make money on. So I would always say take it. But I think some clients need to know that at the end of it, they'll pay for it in some way,
so it's so important to actually, and this is going back to what we were talking about before, is have the discussions, know where you're trying to land, know what you're doing and why, and then tell people what you're doing, and the team of experts around you can be like, okay, that's what you want to do, then this is how I would structure things.
Looking after your future self is just as important as looking after your current self.
And do you know what? I read something recently which really struck a nerve with me, and it was, we see our future selves as somebody different. We see it as a different person. And I guess I sort of do see my future self as someone different. I'll worry about, it's not really me. And so you're more inclined to look after your current self than you are your future self. But by just being mindful of the fact that you want your future self to be fruitful and have choice. I mean, isn't that what we all want? We all want choice.
That's right. And if you've got people on your team
to work or not work,
help point out and give you those choices.
Isn't that what we all want?
And more opportunities.
Give you those options.
The freedom comes back to is what you said, making your money work harder for you, which is what we're all here doing.
Trying to do,
Get you more money at the best price.
Borrowing capacity.
Get the best advice to structure it and get the best properties that you can get. But 100%. It's always about making your money work harder. And all of these tips that we're giving everyone today is about that. Okay, did you know that you could offset some tax? Did you know you can offset interest? So this is super important.
And there might be an interplay between multiple. If you're turning that property over in 5 years, we might have a plan to do fixed interest in advance in that 5th year to offset some of that capital gain. So there's ways to mitigate those future
And just briefly
costs.
on off the plan, I mean, I've had some excellent success with off the plan, where you've purchased something. In fact, my sister, if she doesn't mind me saying it, she just purchased off the plan, and she's had incredible success with that. And yes, you're taking a leap of faith in societal trends and the builder, but that's why we use you, because you know the builders, you know the developers, you know the areas, you know what's going on in the industry. But with off the plan, if you can have a deposit bond, I'm not sure if
I think this is a really good topic. That I think I think this is excellent, and I think that for anyone listening and
next podcast,
following the stories, we will do a whole nother session
because there's tax
off
deductions
the plan,
on that.
because I think we need to cover off quite a lot of topics. So
absolutely.
That will be the next one to come. And as I said before, if anyone wants to reach out or has any questions, they can contact either of us for any more information.